Day 33 of the investment series. Today we'll be doing the problem sets for the fourth chapter, mutual funds and other investment companies. So let's begin. First question, would you expect a typical open-end fixed income mutual fund to have higher or lower operating expenses than a fixed income unit investment trust? Why? So I would expect a typical open-end fixed income mutual fund to have higher operating expenses than a UIT, because in a unit investment trust, once the portfolio composition is set, it cannot be changed. So just because of that simple fact, I would expect costs in a mutual fund to be higher, because I mean, like I said, it's fixed, so there's nothing else to be done. So I might be wrong, but let's see. So the answer is a typical open-end mutual fund would have a higher operating expenses than fixed UIT. Like I said, reason is open-end mutual funds are actively managed. They engage in ongoing portfolio transactions, pay management fees for research and trading, bear higher administrative marketing to 12B1 and shareholder servicing costs. They also continuously offer and redeem shares, incurring related costs. In contrast, a fixed income UIT is a fixed portfolio of bonds purchased and held to maturity with little to no active management after creation. It has no investment management decisions post launch, minimal trading costs, and typically lower administrative and marketing expenses. The fixed unmanaged structure results in significantly lower operating expenses. So that was the first question. Second question is, what are some comparative advantages of investing in the following? A is unit investment trusts, B is open-end mutual funds, C is individual stocks and bonds that you choose for yourself. So I think unit investment trusts, it's the low costs, so the returns should be higher since there are lower operating costs, no 12B1, lower 12B1 fees, no management costs, etc. Open-end mutual funds, higher potential rate of return. Uh, what else? I'll have to see. Liquidity. Yeah, so unit investment trusts, the advantages of investing are low operating expenses, like I said, due to fixed unmanaged portfolios, predictable portfolio and maturity, no manager risk or style drift, no active management risk, holdings are transparent and fixed at inception, definite lifespan for term-based UITs, example bond ladder, open-end mutual funds, professional management for security selection, portfolio rebalancing, diversification accessible with small investment amounts, liquidity through daily redemption at NAV, convenience of automatic investment plans, record keeping, and dividend reinvestment. Individual stocks and bonds, control over specific holdings, buy sell timing, time management, etc. Tax loss harvesting. No ongoing management fees, only trading commissions, ability to tailor portfolio to personal ethics, themes, or income needs, potential for lower total cost for large buy and hold portfolios. So that was the second question. Third question is open-end equity mutual funds find it necessary to keep a significant percentage of total investments, typically around 5%, of the portfolio in a very liquid money market assets. Closed-end funds do not have to maintain such a position in cash equivalent securities. What difference between open and closed-end funds might account for their differing policies? So, because in open-end funds, yeah, this answer I know myself. It's funny. Open-end funds. So there's basically when there is a redemption of the money invested. So, like, say, uh, some shareholder which has shares in a mutual fund decides to cash out, as they say, and demands money to cash them out. So then, what the fund has to do, the open end equity mutual fund, they have to sell some securities to pay for the redemption of the shares. But in a closed end mutual fund, they don't have to sell those securities because some other shareholder, will buy those shares off of the shareholder who wants to sell the shares. So it's basically like the money is like the shares are just shifted in house. So the overarching fund itself doesn't have to uh, doesn't have to sell its own securities to pay cash to the exiting shareholder. So that's why in open end funds, they keep 5% of the portfolio in money market funds. So when these times come when people want to withdraw and exit the fund and want to cash out, they can very easily do so because 5% of the fund is a very liquid money market state which can be sold in an instant and converted into cash, which can then be wired into the exiting shareholder's account. So that was a pretty good answer by me, I must say. But yeah, basically different redemption policies is the answer. Okay, question number 4. Balanced funds. Yeah, question number 4. Balanced funds, life cycle funds, and asset allocation funds all invest in both stock and bond markets. What are the differences among these types of funds? So let's do that. So differences among balanced life cycle and asset allocation funds. Balanced funds maintain a relatively fixed mix of stocks and bonds, 60-40, to provide consistent income and moderate growth. The allocation is typically static or varies within a narrow range. Uh, okay. Life cycle target date funds automatically adjust the asset allocation mix from a more aggressive stocks to more conservative uh, bonds, cash, to as a target ages or as the retirement year approaches. The allocation follows a predetermined glide path. Asset allocation funds actively vary the mix of stocks, bonds, and other assets based on the fund manager's macroeconomic and market forecasts. The allocation is flexible and tactical, not fixed or tied to an investor's age. Pretty good stuff. Question number 5. Why can closed-end funds sell at prices that differ from the net asset value while open-end funds do not? So closed-end funds issue a fixed number of shares that trade on an exchange between investors, like stocks. Their market price is determined by market supply and demand, which can deviate from NAV, trade at premium or discount. Open-end funds continuously issue and redeem shares directly with the fund. At the end of the day, NAV. So transactions always occur at NAV. Pretty good stuff. Then we have question number 6. Question number 6 is what are the advantages and disadvantages of ETFs versus mutual funds? So advantages and disadvantages of ETFs versus mutual funds. Whoa. Yeah, not a good idea. Reformat answer. So I can copy paste. Yeah. Okay. So still going well. Yeah, whatever. Anyways, exchange traded funds, ETFs. Advantages: trading flexibility, trade intraday at market prices like stocks throughout the trading day. Lower costs, typically have lower expense ratios and no investment minimums beyond the price of one share. Tax efficiency, generally more tax efficient due to the in-kind creation redemption process, which minimalizes minimizes capital gains distributions. Transparency, holdings are usually disclosed daily. Disadvantages: trading costs requires a brokerage account. Investors may incur brokerage commissions per trade and face bid-ask spreads. Potential price deviation, can trade at premium or discount to the fund's net asset value. Trading temptation, intraday liquidity may encourage frequent speculative trading detrimental to long-term returns. Liquidity risk, some niche or specialized ETFs may have lower trading volumes, resulting in wider bid-ask spreads. Mutual funds advantages: simplicity of pricing, all buy and sell orders are executed at the day end of the day NAV. So investors do not deal with bid-ask spreads or intraday price fluctuations. Automation, easy to set up, automatic investment plans and dividend reinvestment, often with fractional shares. Direct access, can often be purchased directly from the fund company without a brokerage account. Active management, provide access to professional active portfolio management. Disadvantages: higher costs, tend to have higher average expense ratios than ETFs, may have sales loads front end or back end. Tax inefficiency, more likely to make annual capital gains distributions, creating a taxable event for investors in taxable accounts. Less transparency, holdings are typically disclosed only quarterly or semi annually. Minimum investments. Many funds have minimum initial and subsequent investment requirements. Okay, moving on to the next question. Answer 7. So question 7 is an open-end fund has a net asset value of $10.7 per share. If it is sold, it is sold with front-end load of 6%. What is the offering price? So net asset value, NAV, is $10.70 per share. The front end load is 6%. So offering price will be equal to NAV divided by 1 minus load, which is equal to 10.7 divided by 0.94, which is equal to $11.383 dollars per share. Therefore, offering price equals to 11.383 per share. Okay, offering price equals to NAV divided by 1 minus front end load for whatever reason. I mean, no, makes sense, I guess, makes sense. Anyways, question number 8. Holy hell, that are a lot of questions. Anyways, Jesus Christ. Okay, let's keep going, I guess. Answer. Oh, wait, hold up. Let me reformat this a little bit. I know nobody's ever gonna watch this, but I don't know. This is the only way I can. Probably not the only way, but it's the way that's working. To be fair, I've never come this far at all. Like, I hadn't done past the questions of the second chapter, so I mean, something must be working, right? So yeah, let's just. Can you just put this whole page? Like, copy this page, send it here. No, doesn't work. How about if I just screenshot this whole page? You know what? That's probably not a good idea. How about I just do this? Okay, hold up. Hold on a minute, there, Sheriff. How about 3 questions? Oh, maybe 4. You know what? 4 was fine. Yeah, instead of going question by question, I should upload groups of questions together. Yeah, so the eighth question is, if the offering price of an open-end fund is $12.3 per share and the fund is sold with a front-end load of 5%, what is the net asset value? Yeah, so the offering price of an open-end fund is $12.3 per share. Fund is sold with front-end load of 5%. So basically, it will be 0.95 times 12.3, 11.685, 11.685. Yeah. Question number 9. Composition of FinGroup fund portfolio is as follows. Fund has not borrowed any funds but has accrued management fee with the portfolio manager currently totals $30,000. There are 4 million shares outstanding. What is the net asset value of the fund? So total portfolio value is $42 million. Subtract accrued management fee, $41,970,000, divided by shares outstanding, $10.49 per share. I mean, if I'm doing the question like this, it should be a breeze. The closed fund is a closed-end investment company with a portfolio currently worth $200 million. It has a liability of 3 million and 5 million shares outstanding. What is the net asset value of the fund? So that should be 197 by 5. What is that? That is $39.4 per share. Should be right. What? Did I miss a question in the middle? Oh yeah, I missed a question in the middle. Huh? I missed question number 10. But question number 11 is $39.4 per thing. So that's correct. Part A, yeah, that is yeah, part A. Part A, 39.4 per share. Okay, second question, 10th question is, reconsider the FinGroup fund case problem. If during the year the portfolio manager sells all the holdings stock D and replaces it with 200,000 shares of stock E, $50 per share, and 200,000 shares stock F at $25 per share. What is the portfolio turnover rate? Stock D. Stock D. 200,000. Okay, stock D is 600,000. 925. One to 15 million. Jesus Christ. 15 million, and then you have stocky 200,000. 50. Damn. That is a lot. That's like 10 million right there. And then that's like 5 million has to be. Yeah, 5 million, 10, 15 million. Portfolio turnover rate would be 15 by the total thing. 15 by portfolio value before management fee deduction 42 million, which is equal to 35.71%. Yeah, nobody's going to watch these videos because there are literally like hundreds of millions of videos on YouTube. Probably more. I mean, assuming that half the people that are on YouTube have posted something at least. Or maybe not. I don't know. I don't know how many videos there are on YouTube, but I'm sure there's a lot. So this will just disappear into the archives of the internet. I mean, technically, I'm leaving something out there into the world, these videos. And if I ever matter, ever in my life, if I become someone big and famous and respected that I want to be like, then these videos would be fun to look back on, see how lost and just, I don't know, naive or whatever I was, just trying to figure it out. I mean, I hope I'm looking back on these videos and have finally figured it out, but I probably won't have. It's just scary to think about it, even. But anyways, I can't distract myself like that. Question number 11, part B. If the fund sells for $36 per share, what is the premium or discount as percent of net asset value? So $36 per share. The NAV is $39.4. So 39.4 minus 36 by 39.4, which is 8.3% discount. 8.63% discount. Answer 12. Answer 13. Answer. Oops. How many questions are there? Oh, 25 questions. Damn. I have like an hour left. Might be able to finish it. Who knows? Anyways, it's probably like been half an hour, maybe more by now. Jesus Christ. So yeah, let's go ahead and try to fit all this in. It would be like that. Perfect. Question number, god damn it, what question number is it now? 12th? Yeah. Corporate funds started the year with a NAV of $12.5. By the year end, its net asset value equal to 12.1. Fund paid year end distributions of income, capital gains of $1.5. Equal to 1.1 for a year end distributions of income, capital gains of 1.5. What was the pre-tax rate of return of the investment fund? Pre-tax rate on the investment fund. So rate of return equals to ending NAV plus distributions minus beginning NAV by beginning NAV. 12.1 plus 1.5 minus 12.5, 12.5, which is 8.8%. Then we have 13th question. Closed-end fund starts the year with a net asset value of $12. By the year end, net asset value equals to $12.1. At the beginning of the year, the fund was selling at 2% premium to NAV. By the end of the year, the fund is selling at 7% discount to NAV. The fund paid a year-end distributions of income and capital gains of $1.5. What is the rate of return to the investor, to an investor in the fund during the year? So closed-end fund return, investor rate of return, beginning price, NAV equals to $12, premium 2%, price, ending price. So yeah, let's move on. I really want to just call it quits and just sleep, to be honest. Really tired. Shouldn't be, but I am. It's like, I just want to sleep. I just want to sleep and just never wake up, you know. I just never want to wake up again. I don't want to wake up again. Yeah, it's getting depressing. But I set a goal for myself today and I will complete it. So that's what I'm gonna do. So let's just power through it. Let's have some water. We go 1 hour. We can do this. Okay. Question number 14. Impressive fund. These names, they could have chosen anything. Part A. Impressive fund had excellent investment performance last year with portfolio returns that placed it in the top 10% of all funds with the same investment policy. Do you expect it to be a top performer next year? Why? Why not? No, strong performance last year does not reliably predict top performance next year. Mutual fund returns often show little persistence due to random outcomes, reversion to the mean, changing market conditions, and difficulty to consistently outperform an efficient market. Uh, Part B. Suppose instead the fund was among the poorest performers in its comparison group. Would you be more or less likely to believe its relative performance will persist in the following year? Poor relative performance is slightly more likely to persist if caused by high expenses or poor management, but it's still not guaranteed. Persistence underperformance can stem from structural disadvantages, high fees, but even poor funds can have periods of average results returns. Okay, question 15. Consider a mutual fund with $200 million in assets at the start of the year and 10 million shares outstanding. The fund invests in a portfolio of stocks that provides dividend income at the end of the year uh, of $2 million. Stocks included Stocks included in the fund's portfolio increase in price by 8%, but no securities are sold and there are no capital gains distributions. The fund charges 12B1 fees of 1%, which are deducted from portfolio assets at year end. What is the fund's net asset value at the start and end of the year? What is the rate of return for an investor in the fund? Consider a mutual fund with $200 million in assets. Start of the year, 10 million shares outstanding. Fund portfolio stocks that provides dividend income at the year end of the year of $2 million. Stocks included in funds portfolio increase in price by 8%, but no securities are sold and there are no capital gains distributions. The fund charges 12B1 fees of 1%, which are deducted from portfolio assets at year end. What is the fund's net asset value at the start and end of the year? Okay, so at the start of the year, it's $20 per share. End of the year, price appreciation 16 million because it increased by 8%. Dividend income 2 million. Total asset before fees 218 million. 12 year fees 1% of year end assets 12.18 million. 2.18 million. Assets after fees 215.82 million. Net asset value 215.82 million by 10 million. 21.582. Investors rate of return NAV1 minus NAV0 plus dividends per share divided by NAV0, which is equal to 8.91%. Not that great, to be honest. It's okay, but like it's actually not that good at all. Yeah, like at all. But what are you gonna do? Okay. Oh yeah. Um. Excuse me. Ba, ba, ba. Okay. 16 question. The new fund had average daily assets of $22.2 billion last year. The fund sold $400 million worth of stock and purchased $500 million during the year. What was its turnover ratio? Turnover equals to you sure? Okay. Yeah, turnover equals the minimum of purchase and sales by average daily assets, which is 18.18%. So that's that. 17th question, the new fund expense ratio. CP was 1.1%, and the management fee was 0.7%. Then, what were the total fees paid to funds? investment manager during the year. What were the other administrative expenses? So management fees, 0.7% of average assets, $15.4 million. Total expense ratio, 1.1% of average assets, $24.2 million. Other administrative expenses, total expenses minus management fees, $8.8 million. Okay, which is just the expense ratio, to be fair. Okay. So 18. Yeah. Okay, next up. Oh, what the hell? Where are all the remaining questions? Ah, man, I didn't put the picture. Ah, that sucks. Oh, there it is. Put that in the later section, actually. Interesting. Sure, fine, whatever. You know what? Changing this is gonna be too much work. So let me just do this. Let me just do this real quick. There's that. Okay, 18. Perfect. Okay. Now I can do 23. Yeah, so 18th question is, you purchased 1,000 shares of the new fund at a price of $20 per share at the beginning of the year. You paid a front end load of 4%. The securities in which the fund invests increase in value by 12% during the year. The fund's expense ratio is 1.2%. Really want to finish this. I can't. Just want to rest. Okay, I'll take a mini break. Maybe just 5 minutes. I need 5